Here's what drives the dollar and where it could go from here. Like anything else, currencies are driven by supply and demand. When people around the world want to buy things that are priced in dollars, like US stocks, bonds, real estate, or whatever, they need dollars to do that. In order to get them, they have to sell other currencies and buy dollars, which drives the dollar up. So what really matters for dollar strength or weakness is global demand for assets priced in dollars. Demand for US assets has been rising for three main reasons over the past 15 years, which is why the dollar has strengthened by over 35%. As you can see by the green line, which shows the price of the dollar index using the numbers on the right. The first and most important reason for dollar strength has been interest rate differentials, which just means the difference between the interest rates you can get on US government bonds versus other bonds. Think about it. If you can get a higher yield on a US Treasury bond than a UK gilt or a German bond, even after the cost of hedging your currency, why wouldn't you do it? Many foreign governments, institutional investors, and sovereign wealth funds bought treasuries for exactly that reason, which was a key source of the dollar's strength. You can see the relationship pretty clearly from the chart where the black line is the interest rate differential between US and Eurozone bonds, and the green line is the dollar index. From 2009 to 2012, as the interest rate differential fell, the dollar weakened. And then from 2012 to 2020, as the interest rate differential rose, the dollar strengthened. You may have noticed there have been two periods when this relationship didn't hold up. And that brings us to the two drivers of dollar strength: economic crises. If you focus in on the periods around 2008 and 2020, you can see that the interest rate differential fell, but the dollar strengthened. That's because the dollar is seen as a safe haven asset. So in times of panic, people usually park money in ultra safe US Treasury bonds. What does that rising demand for US assets do? It drives up the dollar. Also, it lowers the rates on bonds, because remember, when bond prices go up, yields go down. And all that extra demand for Treasury bonds drives their prices up. The third reason for dollar strength over the past 15 years is demand for US stocks, which have done way better than non-US stocks, causing trillions of dollars to flow into the US stock market and driving up the dollar. To sum up our key points, currencies, like everything else, are driven by supply and demand. When people buy US assets, they have to buy dollars to do that. So the dollar has strengthened due to higher demand for US stocks and bonds. And demand for US stocks and bonds has been driven by strong US stock returns, increasing interest rate differentials between US and non-US bonds, and a couple economic crises. So where do we go from here? Well, for about the last 7 months, the dollar has weakened because people have been expecting US interest rates to fall more than European interest rates, aka the interest rate differential has been narrowing. However, right now the market is already pricing in that the Fed is going to cut interest rates a lot by the end of the year. There's just one problem with that. The Fed is saying they're not going to do that. So I see two ways forward in 2023. Either the market realizes the Fed is not bluffing and they don't cut rates as much as expected, which would increase the interest rate differentials and likely drive up the dollar, or we get an economic crisis and they do cut rates a lot. But what happens in an economic crisis? The dollar strengthens. In my opinion, an economic crisis is pretty much the only way they would cut rates a lot this year. Remember, they cut rates to stimulate the economy and they raise them to fight inflation. Well, if inflation is above the 2% target, then they shouldn't be cutting rates, right? Ideally, they still be keeping them high so inflation keeps falling. The only way inflation falls to 2%, or they decide to cut rates while it's still higher, is if the economy, and specifically the job market, weaken significantly. That would only happen in an economic crisis, which typically causes the dollar to strengthen. Over the longer term, like the next few years, I do think the dollar will weaken. It goes back to the same drivers that made it so strong the last 15 years, which could be reversing. Interest rate differentials were rising, and I think they'll fall because there's more downward pressure on US inflation and interest rates than there is on non-US inflation and rates. I also think non-US equities will do much better over the next 10 years, which I've mentioned before a few times, and we'll be happy to make a full video about it if you're interested. Let me know in the comments. Forecasting the dollar is cool and interesting, but it's probably not going to do much for most people. If you really want to change your life by becoming a better investor, check out my free webinar below called The 9 Secrets of Successful Investors.